A few days ago, something happened in the global market that most investors completely missed. Gold, the assets that people trust when the world feels unstable, suddenly started slipping. Not a small dip, a sharp move that caught traders off guard. And when analysts started digging into the reason, one name kept appearing, again and again: China. Yes, the same country that has been one of the biggest buyers of gold for years is now being linked to a move that could push prices down. The question is simple, but the answer could change the way investors look at gold forever. What exactly did China do? And why could it crash gold prices? Before we go deeper, if you enjoy simple explanations about gold, silver, and the global economy, make sure you hit the like button and subscribe to the channel. Here on Past and Profit, we break down complicated financial stories into clear insights so you can understand what is really happening behind the headlines. For decades, gold has carried a powerful reputation. When stock markets panic, when inflation rises, or when geopolitical tensions grow, investors usually run toward gold. It has been seen as the ultimate financial safety net, a physical asset that governments cannot print out of thin air. That reputation is why central banks around the world keep huge amounts of gold inside their reserves. And for the past several years, one of the biggest buyers of gold has been China. The Chinese central bank has steadily increased its gold holdings. Many analysts believe China was preparing for a future where the global financial system becomes less dependent on the US dollar. By accumulating gold, China could strengthen its financial independence and build trust in its currency. Because of that long buying trend, many investors assumed China would continue pushing gold prices higher. But markets do not move on assumptions. They move on actions. And China's recent actions are starting to look very different from what many expected. One major factor that shocked the market is the possibility that China has started adjusting its gold strategy. When a country that large shifts its position even slightly, the global market feels it immediately. Gold is a massive market, but it is still very sensitive to supply and demand changes. If a major buyer slows down purchases or begins selling part of its holdings, traders notice quickly. Some reports suggest that Chinese financial institutions and state-linked entities may have reduced their pace of gold buying. Even a pause in buying can create pressure on prices because the market had become used to China being a consistent source of demand. When that demand weakens, prices can start drifting lower. But that is only part of the story. The bigger shift could be happening in China's financial strategy. Over the last few years, China has been investing heavily in digital finance. The development of the digital yuan has been one of the most ambitious central bank digital currency projects in the world. Unlike cryptocurrencies, this digital currency is fully backed and controlled by the Chinese government. Now think about what that means for gold. For thousands of years, gold has served as a store of value because it is scarce, physical, and widely trusted. But if a government successfully creates a digital system that people trust for transactions and savings, the role of traditional assets like gold could start to evolve. China appears to be building a financial ecosystem where digital currency plays a bigger role in international trade and domestic payments. If that system grows, the government may not need to rely as heavily on increasing its gold reserves. That shift alone could change market expectations. Another piece of this puzzle involves China's broader economic policy. The Chinese economy has been going through a complicated period. Slower growth, real estate challenges, and global trade tensions have forced policymakers to rethink certain strategies. Sometimes governments adjust their reserve assets to stabilize their financial system. If China decides to move capital into other strategic assets, such as technology investments, infrastructure projects, or foreign currency reserves, gold might temporarily lose some priority. Even small reallocations can create waves in global markets because investors often copy what large central banks are doing. But there's also a psychological side to this story. Financial markets are driven not only by real transactions, but also by expectations. When traders believe that a major buyer might slow down or change strategy, many of them react before the move even fully happens. Hedge funds, institutional investors, and algorithmic trading systems all start adjusting their positions. This creates momentum. A few early sellers can trigger larger selling. As prices begin to drop, more traders jump in expecting further declines. What started as a small shift in policy can quickly turn into a noticeable price drop. This is one reason why gold sometimes behaves in ways that confuse everyday investors. People assume gold always rises during uncertainty, but the reality is more complicated. Gold is influenced by interest rates, currency movements, central bank policies, and global liquidity conditions. When several of these factors change at once, the result can be unexpected. For example, if interest rates in major economies remain high, investors might prefer bonds or savings instruments that generate income. Gold does not produce interest or dividends. Its value comes mainly from price appreciation and long-term stability. When safer assets start offering attractive returns, some investors temporarily shift away from gold. Currency strength also plays a major role. Gold is usually priced in US dollars. If the dollar strengthens against other currencies, gold often becomes more expensive for international buyers. That can reduce demand and create downward pressure on prices. China sits right in the middle of this global financial web. Its decisions influence trade flows, commodity demand, currency movements, and investment sentiment. When Chinese policymakers adjust even a small part of their financial strategy, the ripple effects can spread through multiple markets. And that is why analysts are paying very close attention to China's recent moves. If the world's second largest economy is quietly reshaping how it manages reserves and financial technology, it could change the long-term outlook for gold. But here's the important point many people overlook. A short-term price drop does not automatically mean gold is finished as a safe haven. In fact, gold has gone through many cycles like this before. Periods of consolidation and correction often happen even during long-term bull markets. History shows that gold tends to move in waves. Sometimes prices surge rapidly when fear dominates the market. Other times they cool down when economic conditions stabilize or when investors move into other assets. These cycles are normal. What matters more is the long-term direction of global financial stability. Governments around the world are carrying massive levels of debt. Inflation remains a concern in many economies. Geopolitical tensions continue to rise in different regions. All of these factors traditionally support the case for holding gold as part of a diversified portfolio. So while China's actions may have triggered short-term pressure on prices, the bigger picture remains complex. Investors need to watch whether this is a temporary adjustment or part of a larger structural shift in how central banks manage their reserves. Some analysts even argue that China might simply be repositioning itself strategically. Instead of aggressively buying gold at higher prices, it may wait for corrections before increasing reserves again. Large institutions often move this way because they want to buy assets when prices are favorable. If that scenario plays out, the current drop could eventually become an opportunity rather than a warning sign. Markets often punish emotional decisions. The investors who step back and analyze the bigger picture usually gain the advantage. And this is exactly why understanding global economic moves is so important. A decision made in Beijing can influence investors in New York, London, and Tokyo within hours. The world's financial system is more connected than ever before. Here on Past and Profit, we focus on breaking down these global connections so everyday viewers can understand what powerful institutions might be doing behind the scenes. Because when you understand the forces moving the market, you are less likely to panic when prices suddenly change. Right now, the key question investors are asking is simple. Is China temporarily adjusting its strategy, or is this the beginning of a deeper shift in the global gold market? The answer could shape the future of precious metals for years to come. If China continues pushing forward with digital currency development and changes its reserve allocation, gold could experience more volatility in the short term. But if global uncertainty rises again, demand for physical assets could quickly return. That tension between new financial technology and traditional safe haven assets is one of the most fascinating battles happening in the economic world right now. Gold represents thousands of years of financial history. Digital currency represents a potential future, and China is standing at the center of that transition. As investors watch these developments, one thing is clear. The gold market is entering a new chapter where geopolitical strategy, technology, and central bank policy all collide at the same time. Now, I want to hear your perspective. Do you think China's latest move could push gold prices lower for a long time, or is this just a temporary shakeout before the next rally? Drop your thoughts in the comments below, because the discussion around gold right now is one of the most important conversations in global finance. And if you found this breakdown helpful, share this video with someone who follows the gold market so they can see what might really be happening behind the scenes. Thanks for watching Past and Profit, and stay tuned because the next big move in gold might come sooner than anyone expects.